Welcome to Live at the Nut Bar. Welcome to another edition. Today's edition is called Refixes, Cashbacks and Curveballs. So it's all about how, as a borrower, you can think about, what term should I take if I'm refixing? What term should I get in the first place? What's this thing called cashbacks all about and why it works the way it does, and some tips and tools to better manage your home loan. So I'm joined today by Dave Tyrer, who he's going to give a bank's perspective on why they do what they do. Dave was a banker for many years, so he's going to give that perspective. Then McInnes is one of our great advisors in the Squirrel team, and she'll give the customer perspective in terms of what to do, how to engage with an advisor or with the bank directly, what are the things to think about. Curveballs wise, Dave will probably talk a little bit about things called break costs, which are a bit of a sort of a challenge when we think about this too. So definitely the rose between two thorns here. Hey, to get started, Dave, when we were back in banking many years ago now, it was always competition on the interest rates, and we sort of saw the margins of home loans really tight. They're probably 2 or 3 times what they were then. Why has that happened, and what's happening? Is there competition in banking these days that influence, what the deal a customer is going to get?
There's a balanced or nuanced answer here, I think. So is there still competition? And if I concentrate on home loans, I think the answer is yes. A couple of years ago, we saw ASB go really hard to try and lift home loan rates in the market. And actually, they suffered as a consequence, and they saw business go other places that were pricing better. So there's a bit of competition you see there, but at the same time, the banks have been doing a really great job of protecting their margins and rewarding new business and not rewarding loyalty.
So that's the key point here, isn't it? The rewarding of new business. So how do they reward new business? It's not through interest rate, is that what you're saying?
Well, I think that's where if you can hold your interest rate up and do something like a cashback for a new customer, rather than giving a benefit to all of your customers, that's one way of helping protect that margin that you're trying to hold between what you're lending at and what you're raising your deposit.
So are you sort of saying that the existing customer pays the higher interest rate, the new customer might pay the same rate, but gets this other little gift to make it attractive to join that bank?
Quite right.
It's sort of cynical, isn't it?
This is very cynical. But, banks are good at making money. It's one of the ways that they do it.
Okay. And so, Kat, turning to you, when this cashback thing, how does it work? Can you just explain?
Yeah, essentially, so when you're taking a new loan with a bank, the bank is going to reward you, I guess, with the cashback.
It's got to be a new loan?
Well, I'll come to that, not necessarily. So the bank is typically going to be giving you, at the moment, between 0.8% 0.9% of the loan amount as a cashback.
So let's just pause there. So if my loan is $700,000, I might be getting $7,000 back.
Potentially, yeah. Easier maths for me. If your loan's $1 million, you'd be looking between 8 and 9. Yeah. So the but with that is that it does come with a clawback period. And so if you were to move your banking away from that bank or repay your lending within a certain period, generally 3 or 4 years, the bank will have the right to ask for part of that cashback back. So essentially buying a little bit of loyalty.
Right. So interesting, buying loyalty. And if 3 or 4 years, is it not the same between each bank in terms of that clawing back? Cashback?
Yeah, largely 3 years. So there are still a couple that have a 4-year clawback period.
Do you find as an advisor that that's generally no problem? People tend to stick with the bank for a few years, or
they do tend to, and I think largely it is because of that cashback. Because if we are looking at the option to move them to another bank, there is that clawback that's going to happen.
Yeah.
Once they come out of their clawback period with the bank, that's when we have got the option to be looking at what else is out there for them. And they have the opportunity to get a fresh cashback with another bank. So
the clever thing to do is to change banks every 3 years and get another cashback from each bank. You're going to get pretty much the same interest rate from every bank, are you, these days?
At the moment, there's always exceptions like Dave referred to with ASB, but at the moment we're seeing pretty steady rates from everyone. So sometimes it is that cashback that's going to make the difference.
Yeah. And what do you have to use that cashback for? Is it for legal fees or stuff like that, or is it just a freebie to buy Christmas presents, go on holiday?
Pretty much. I think, and I was sort of showing my age too, but, in the old days it was sort of referred to as a legal fee contribution. But now it is yours to do with, as you please. You can go on holiday, you can buy Christmas presents. An advisor would probably tell you to use it to pay down the mortgage, and that would be the smart thing to do, but it is your call.
Yeah. So if you paid down the mortgage, you might borrow $600,000, and in fact it was $594,000 after you put your cash back to it. What percentage of people do you reckon do that?
Or probably close to zero, I would say.
Yeah, and what's the most exotic thing you've heard someone do with their cashback?
Oh, I don't know, actually, probably a holiday. Yeah.
So cashback's sort of part of it, but the most important thing with a loan is, you've got a principal, you've got a repayment term, an interest rate. Now, of course, interest rates aren't that simple either. There's floating, fixed, 6 months, 1 year, 2 year, 3 year, 4 year, 5 year. How, as an advisor, do you determine what's right for a customer?
Yeah, so just really talking to our clients and finding out where they're at the moment. So if we've got clients that are a little bit more conservative, perhaps the budget's really tight, we might have people perhaps planning maternity leave, something like that. It can make sense sometimes to fix a little bit longer.
So the reason for that is you have absolute certainty how much you're going to be paying.
Yes, yeah. If you've got a higher discretionary income and you're sort of quite happy to have a bit more flexibility, which can be useful, particularly if you're trying to pay your loan down quite quickly, then a shorter term fixed may be more appropriate. As a general rule at the moment, I would probably be recommending a split approach. So having some on a shorter term for some flexibility and some slightly longer just to give that certainty.
So when you say shorter term, what term are we talking? 6 to 12 months, and longer term?
Probably 2 to 3 years.
2 to 3 years.
I wouldn't be seeing much going any longer than that at the moment.
Yeah. So is 5 year a very common choice for customers?
No.
'Cause that's a long, okay, why not?
I think a couple of reasons. I think most of us, it's a struggle to sort of think. You've got to think about what you're going to be doing within your fixed term. I think, are you likely to be, is your financial position likely to change much? Might you be wanting to move on from that house, renovate? There's lots of things that come into it. I think most of us can think 1, 2 years in the future, maybe 3. A lot of us, it's hard to look out to that 5-year mark. And I guess as an advisor, 5 years can make us a little bit nervous, just because if there is a change, a drop in rates, break fees on a longer term can be quite significant.
Okay, we'll come back to break fees. Dave, from a banking perspective, the yield curve is normally upward sloping, isn't it? So your 1 year wholesale rate will be lower generally than your 5 year rate.
That's right.
Why is that?
Well, a lot of it's to do with the time value of money and the risk of what might happen in the future. Like, it's probably more certain what might happen in the next 12 months than what it is over 5 years. And so that uncertainty typically or theoretically causes the longer rates to go up a little bit more.
Yeah, so it's actually, if you just stand back and think 5 years ago, we just had COVID, interest rates had started here, they'd gone to 0.25% on the OCR. Then the housing market boomed and property prices went up 40%. And then interest rates started to rise and they went from 0.25 to 5.5. And then the property market slumped 25% in Auckland and Wellington. Interest rates have come down. They've sort of dropped the OCR from 5.5 to 3. So I guess there's a really good illustration of, but hey, wouldn't you be happy if you'd locked in one of those really low rates 5 years ago though?
100%. There was a 299 for 5 years on offer, but hindsight's a beautiful thing.
Yeah, so there are situations, the point is there are situations when you want to definitely be thinking about long term. So when interest rates are really low, it's hard to pick the bottom, and when interest rates on 5 year were 2.99, you could get a 2.19% 1 year rate. So you were giving up something to get that long term rate. So generally at the bottom, you should be thinking more about long term. When you're at 7.3%, which was, I think, the highest interest rate in this cycle, that's a time to go short, even though actually at the time the 5 year rate was a bit lower, I think. Yeah. So, at the top and bottom, quite short terms at the top, or when interest rates have that feeling of falling, and the opposite at the bottom, even though you might be giving up something. Yeah.
The other thing that happens is you go through that interest rate cycle. Often when you get to the top of the interest rate cycle, margins get squeezed. So banks are trying not to put that rate up as far. And so you get that squeeze up in margins. And sometimes that will cause the banks not to offer a cashback, right? So there'll be times during a cycle where they're thinking, oh, jeepers, margins are tight. Actually, I'm not going to do that. I'm just going to manage the overall interest rate. So banks can come in and go out with those freebies or those incentives.
Has that happened, Kat, over the last, couple of years, 2-3 years, where cashbacks have sort of disappeared maybe, or have...
Not altogether. We've certainly seen adjustments to the amount of cashback. About probably 6-8 months ago, we were typically getting 1%. So that's come back to sort of the 0.5, 0.85, 0.9 mark. We've also seen some adjustments where the banks might sort of adjust the cashback depending on your actual LVR position. So it's a more tailored kind of offers.
So the LVR, that's the loan to value ratio. So if it's, I don't know, an 800,000 property, what's sort of the threshold? If I'm borrowing, say, 80% of 800,000, 640,000, is that the sort of trigger, like over 80% borrowed?
Yeah, typically it's typically going to be 80%. It was actually ASB as well that did do this. We had a period where investment properties over, I think it was 70%, even if they were exempt for some new build property, that they were reducing the cashback in those instances. So it's not a given.
Yeah. Okay. You mentioned break costs. So what's a break cost? I'll ask you, and then Dave, I'll ask you why we have these damn things.
So I'll probably give you a very simple answer compared to Dave, but essentially when you borrow money from a bank, the bank is also borrowing that money for the same term, and you are contracted into a particular term. If you break out of that term early, the bank is going to be looking to get back any loss if interest rates have dropped in that time.
As a borrower, you're borrowing, say, for 2 years at whatever rate, the bank is funding that or hedging it in the wholesale markets for 2 years. And if you break out of your contract, then the bank's got a contract to break out on the other side. If interest rates have fallen, there'll be a cost. So Dave, can you explain why how that cost works? And, isn't it a two-sided equation? Do banks sort of pay you if it's to their benefit?
Well, back in the olden days, actually, they did pay you if it was to your benefit, or you may have got some of the benefit. But these days they've removed that clause. So pretty much they just claim back pretty much their real costs of breaking that financial contract. You break a contract, often there's some sort of penalty that goes with it, whether it's a mobile phone or whatever it happens to be. This is not really any different.
So it's sort of fair enough, yeah.
Yeah.
And it really only happens if interest rates have fallen, is that right?
That's right. So if interest rates are rising and you're breaking out of a lower rate and going maybe into a higher rate, or just paying your loan off on that lower rate when interest rates have gone up, there's actually no cost to the bank. There's probably a benefit in it, so they don't charge you anything.
So they keep a benefit but don't charge you anything. Yeah, okay. But equally,
cynical banker.
If interest rates have sort of risen, it's in your interest to keep that lower interest rate, obviously.
That's right.
And is the break cost sort of the same if I've got a 1 year to go on my loan or a 5 year? Does that make a difference?
It changes, yeah. So the length, or how far away from the end of the contract are you, will often determine how much that cost is, plus the movement in interest rates that you've got at the time. So they're both factors, the time left and the movement in rates, both.
So if we sort of think about it, the movement in rates, let's say it's 2% down, and if I've got 1 year left, it's whatever amount, $500,000 times 1% is pretty much what I'll pay. If it's 2%, it will be, 2,000, 2% of the total. But if it's for 4 years to go, it will be 4 lots of that. So that's sort of a downside of those longer term rates, unless interest rates are expected to rise, I guess. So if you're sort of taking a longer term rate at the top of the interest rate cycle and you want to break out of it, it could be a big number. Yeah, I mean, I've seen numbers in the tens, or I think I've seen one close to $100,000. So without scaring people, that was a very big loan. But those numbers can mount up if the interest rates, the term is quite long and the interest rate movement is quite significant. So, Kat, if I've got a fixed rate that's coming up for maturity, what should I do? See you, I guess.
That's probably what I'd say first would be chat to an advisor.
Chat to an advisor.
Yes, yeah. Particularly at the moment, because rates have come down so relatively quickly from where we were last year. So it's a really good opportunity, not just to be able to lock in a lower rate, but actually to start to think about what you can do with that extra money that's going to be available to you.
Yeah. So you might be coming off a sort of 7% interest rate. What do you normally recommend if the interest rates come down and I was managing at that higher interest rate? What do you typically advise?
If you were managing okay, then I would typically advise you to keep your payments the same. And that's probably, I think most people are sort of savvy enough that before they've talked to us, they've already had a look at what the rate's going to look like. They can see what the new repayment would be. But probably the thing that surprises clients the most is that if they did keep those payments the same, the impact that would have on their overall loan term and their overall interest cost, it's incredibly powerful.
Yeah, it's sort of the magic of compounding interest from an investment perspective, a bit in reverse. If you can pay off your loan faster, the amount of interest saving and the number of years you can take off your loan can be, a 7% to 5% interest rate. It's probably, 5+ years off your mortgage and save you a few $100,000 of interest, over that very long period. Yeah. So it's the magic of compounding.
Yeah. And I think the other thing too, so for a lot of clients, they have been finding it tight. And so they do need the cash flow relief of the lower rates. But it doesn't have to be completely one or the other. So I've had quite a few clients who've sort of gone down the middle. So they've dropped the payments a little bit, but not right to the minimum. And we're still getting that effect of them paying off their loan a bit more quickly, but with a bit of cash flow relief as well, which is nice.
What about if I've got, we often talk about, you were talking earlier about splitting interest rates. So you might have sort of, say, some on 6 months and some on 2 year. What happens? What do you do if after 6 months you've got to decide what to do, but you've got a whole lot of loans at 2 year? You can't just switch to another bank, can you? Because that break cost and all that, cashback, clawback can come into play. So how do you deal with those situations?
Yeah, so it's sort of about looking really at the whole picture. So not just the loan that you've got coming off the rate, but also looking at the ones that you have fixed. We can help with getting indicative break costs for those loans that are fixed for longer. And it just becomes a bit of a maths equation. If you're looking at what the break cost is, what would be your interest savings if we broke it and moved you onto a lower rate or took you to another bank, got your cash back? Do the numbers work or do they not? And that's where we can help.
And would part of the strategy potentially be to, if you've got one rate maturing, to roll that over to match the other term, so as everything comes up at the same time?
Yes, it definitely puts you in a more powerful position to be able to negotiate.
So if you've got your whole deal to put on the table and, find the best deal in the market. So you did touch on the start about, generally you have to change banks to get a cash back. But you said generally, so what's the exception?
So,
and
why would not always. So the banks will sometimes offer what they call a retention cashback. This is something more so than the cashbacks for new lending. Retention cash is something that we see probably come in and out of market more often. Perhaps at the moment when the property market's a little bit slower, we are seeing that most banks will be willing to offer a cashback to keep a client with them.
That's crazy. Is that a hard conversation with the banks for a customer? I'm going to leave you unless you bribe me.
Well, we'll do that for you. So you don't have to have the awkward conversation. But it's not going to be as much as if you move to a new bank. And that's just the reality. So you might be looking at perhaps sort of 0.25, 0.3 of the loan amount versus that kind of 0.8, 0.9.
So why would a bank bribe you to stay? And it's like a bribe or a...
Well, how much hassle is it to move the bank, right? In some ways, it's relatively easy. There's not too much you need to do. Go talk to your lawyer and talk to people like Kat to get that done. But sometimes you just think, oh, too hard. Okay, if they're going to give me 25 points, I'll just take that and just put that in my back pocket and happy days.
And the bank will pay because they've got to go and win a different client to make up that one they've just lost. So they could pay a % to get a new client and maybe 0.5 to attain the existing one. It's a dirty sort of system, isn't it, really?
It is.
Dave's right, though. That would be the number one reason, that people do decide to stay is they just
don't want to hassle.
Can't really, don't want to
Do
hassle.
legal fees come in? So if I'm moving my mortgage from one bank to another bank, there's a legal fee to pay and stuff?
Yes, generally in most cases. So that's something else that we have to take into account when we're looking at those numbers. So you've got the shiny cashback, but we've got the break costs we're taking into account, also things like your legal fees.
Hey, Kat, one of those things that is a hassle when you're moving banks is all your transaction banking, like your transaction accounts and your cards and all that sort of stuff. So how disciplined are the banks in forcing you to move your transaction banking and move where your salary comes into?
Yeah. So it's generally a condition of the cashback that you have a salary credit going to the bank. It doesn't mean you actually have to move
Or your banking.
Or your day-to-day banking over if you don't want to. I do think it is easier to have all your banking in the one place. And in terms of some of the ways we structure lending, it can be more efficient as well. But it's not something that you absolutely have to do straight away.
So if you've got like direct debits and all that stuff, do you have to go through the hassle of changing that, or does the banking system look after that for you these days?
I think a little bit of both. The banks can do it for you, and I can't guarantee it would be an absolutely seamless experience, but yeah.
So it is still, I think what you're saying is it's still a hassle to change banks, and so that's one of the factors to take into account.
There's still a bit of work in it, but what I say to people is I say, think about what your hourly rate is at work. So this might take you maybe a couple of hours to do all of this, but if you're getting a cashback that's worth a week's salary or something to you, perhaps it's worth your time.
The best paid job in the country. Unfortunately, you can only take that job for 2 hours, not every hour of the year. So what you're saying is it could just be as simple as a couple of hours. So what sort of things are you going to have to, if I was a customer, I was talking to you about switching banks to get a cashback, maybe a better rate, whatever it is. I don't like the experience of the bank. What information will I need to provide you to arrange that for me?
Yeah, so it's much the same as when you're first buying your house. We do have to go back through your statement of financial position. We have to retest your servicing ability with the banks, look at the value of the property. So it's going to be things like providing us with your bank statements, your proof of income, all of that sort of thing again.
Yeah. So pay slip or seeing the pay going into a bank account. So it's the bank statements. It's really one of the main things. What your assets are. Do you need to get a valuation on your property normally?
It depends. I mean, that's a bit of an interesting one with the value drop. So we are seeing a few clients who've bought in the last couple of years where unfortunately the value has dropped and we're not able to move them because the bank, if we're moving to a new bank, they're going to be looking at the value as at today.
Yeah. So if I paid $1 million for the house and it's now worth 800, then it might be hard. Yeah.
We might be sticking with it.
This is a smaller portion of the customer group, but it's nevertheless something to. But again, talk to your advisor and they'll work it out for you.
Yeah.
Yeah. Dave, what other sort of things spring to mind from with a banking hat on to worth sort of think about in there?
So much of it comes down to margin management when you're sitting inside a bank. So, where am I setting my term deposit rates? Where am I setting my savings rates as interest rates are moving? And where do I set my lending rates? And playing the competition on both sides of that thing. So, you see more competition in deposits sometimes more in lending, and that can kind of dictate your pricing strategy overall. You also see banks dive in sometimes and are more aggressive. We've seen one particular bank at the moment that's kind of doubled the amount of share that they get from Squirrel brokers because they've been a lot more aggressive with their pricing in the last 2 to 3 months. So you really do see banks want business or pull back a little bit and take a bit more margin. So they really do leap in and leap out at different times for different reasons as they try and manage their overall profitability. But yeah, that margin management, they spend a lot of time on it.
Yeah, because it used to be a job, right?
That's right.
Yeah. Hey, so Kat, can you do this yourself? Like, do you have to use an advisor like you, or is it something you can perfectly easily do yourself at home?
And you're not going to be all biased to my answer here, but look, I mean, you can do it yourself. But I think the thing is that it's not just about shopping around for the cheapest rate. There's little nuances with each of the bank's policies that might mean one bank works a lot better for you, or you might be at a particular point in your life. If you're, an example is taking maternity leave. There's some banks that'll still be absolutely fine to do a refinance for a client in that position. There's some that will make it more difficult. I think the beauty of speaking to an advisor is we know all of that stuff up front, because who really wants to sit and call around 3, 4, 5 banks? They ask the same questions from every single one of them when you could just talk.
So this is your day job, you do it all day, every day, so you know exactly what's going on, and the other sort of 50 advisors at Squirrel can tell you if they've experienced something that would be useful for everyone to know.
100%. Yeah.
Okay, that's awesome. Hey, that's been really valuable. Here's a guide that Squirrel publishes called Your Guide to Refixing Your Mortgages, and it covers a fair bit of what we've talked about today, so you can download that from the Squirrel website. Kat, thanks for your wisdom, and Dave, thanks for sharing with us the ins and outs of why banks do what they do, which helps explain why things as they are. I think the key message is, there's if you play it smart, you can do financially better for yourself. Either pay off your mortgage faster, maybe get a little bit of cash for your Christmas presents, and be better off. So make the most of it. Thanks for listening to today's podcast. If you have any questions or things you'd like us to talk about in the future, get in touch with us at david@squirrel.co.nz or john@squirrel.co.nz. And please do share this and subscribe anywhere you get your podcasts. The opinions expressed in this podcast are not financial advice or a recommendation of any financial product. Any commentary provided are personal views and are not necessarily representative of the opinions of Squirrel. As always, we recommend seeking professional investment or mortgage advice before taking any action.